Okay, so today we'll be discussing the concept of equilibrium, and three major objectives of this lecture are first to discuss what equilibrium price and equilibrium quantity mean as concepts. Second, talk about the new term shortage and surplus within the context of the market, and talk about how the presence of shortages and the presence of surpluses lead the market towards equilibrium in most instances. And then we'll do some examples to kind of show how changes in supply, changes in demand can lead to changes in the market equilibrium. Okay, so to kind of introduce some real quick, real fundamental concepts, when talking about equilibrium in the marketplace, what we're really talking about is an environment where agents on either side of a transaction, supply or demand, really have very, very little incentive to change their behavior. So buyers have very, very little incentive to bid up prices, and sellers have very, very little incentive to bid down prices. Another way of thinking about this is that there are no additional gains from trade to be had. We're going to be talking a lot about equilibrium price, which I denote as P star. And the equilibrium price in the market, as we'll see in the next slide, is just a price that sets quantity demanded equal to quantity supplied. In addition, equilibrium quantity, which I'll denote as Q star, is the quantity that sets the height of the demand curve equal to the height of the supply curve. Visually speaking, in equilibrium can be as the point where the supply curve intersects the demand curve. So at this intersection point, the price that prevails is going to be P star, that's the equilibrium price, and the quantity that prevails would be Q star, that's the equilibrium quantity. Now, whether or not this intersection point happens to be the actual equilibrium is sensitive to some assumptions that we make about competitive market structures and whatnot. But for now, this setup is how we're going to identify equilibrium. And you can see that we can also quickly identify consumer surplus and producer surplus just by looking at those triangles that we've identified in previous lectures. So for consumers, their surplus is the area, again, below the demand curve, above the price that prevails in the market. In this case, it's P star, up to the quantity consumed or purchased, that's Q star. And for sellers, the producer surplus is the area above the supply curve, below the price that prevails in the market, and up to the quantity sold, which in this case is also Q star. So we can really quickly identify the surplus in the marketplace, which is the summation of both consumer and producer surplus, just by looking at a diagram like this. Mathematically, I could throw some numbers up, such as with some clearly identified y-intercepts, price and quantity, and you could quickly calculate the consumer and producer surplus. Now, so for instance, let's consider an example where the price that prevails in the market, P prime, lies above P star, lies above that point where the two curves intersect. Now, it's quite clear that at P prime, the quantity supplied is going to be out here, the quantity demanded will be down here, so quantity supplied is going to exceed quantity demanded. We call that a surplus. Or oftentimes textbooks will say there's excess supply. Excess supply to the degree that quantity supplied exceeds quantity demanded. For our purposes in this lecture, that's a surplus. Now, when there's a surplus in the marketplace, we have what we call dissatisfied sellers. And a dissatisfied seller is just a seller. So any of the sellers that fall along this portion of the supply curve, unit cost is at or below the P prime. When these sellers are not able to sell to buyers. Why? Because there are fewer buyers and there are sellers in this case. Now, dissatisfied sellers, especially those who are relatively low cost, those who are on this lower portion of the supply curve, have an incentive to compete with other sellers to guarantee that they get the sale by lowering their prices. Now what that's going to do is that's going to make it harder for sellers up here on the margin to really stay in the market, because these are relatively high cost sellers, so they can't really stay in the market at such prices decline by much. They're going to find it more to their advantage to produce and sell the next best opportunity that they have to them. So as low-cost sellers, especially those down here, okay, as low-cost sellers bid down market prices, okay, we're going to see a movement down along the supply curve, a reduction in quantity supplied, and a movement down along the demand curve, which is the increase in quantity demanded. And this process will continue so long as there's a surplus. This process will continue until we reach a point where sellers no longer have an incentive to lower their prices. That's going to be a case where there's no longer a surplus, which, as we can see in this diagram here, is going to be at a price of P star, where both quantity supplied and quantity demanded are at Q star, meaning that there are no more dissatisfied sellers. Another way of looking at consider a case where maybe the market is producing too much relative to the equilibrium quantity Q star. So we can imagine a world where there are Q prime units being produced, which is to the right of Q star. Now notice that at Q prime, the opportunity cost of producing that Q prime unit, the height of the supply curve, is higher than the maximum price that buyers are willing to pay, as measured by the height of the demand curve. So visually, we can see that at a quantity of Q prime, the cost of producing that unit is P double prime, whereas buyers are only willing to pay at most P prime. So we've got a problem here, because the minimum price that sellers are willing to accept now exceeds the maximum price that the buyers are willing to pay. So really, for any of the quantities to the right of Q star, where the height of the supply curve exceeds the height of the demand curve, it's going to be really impossible for sellers to find buyers to pay them the price that they require at minimum. So one way that we can look at this scenario for all those quantities to the right of Q star is that they represent wasted resources. These are quantities that, when produced, or commodities that, when produced, generate costs to society, as measured by the height of the supply curve, the minimum price that the sellers are willing to accept, costs to society that exceed the benefits to society, that is measured by the height of the demand curve, the maximum price that buyers are willing to pay. So it makes natural sense for society to produce less of this commodity. How does that come about? Well, for all these quantities to the right of Q star, it's really impossible for sellers to find buyers that are willing to pay a price that offsets their costs. So it won't take long for sellers to leave this market. The sellers that are producing way out here to the right of Q star will soon realize that they can't sell their commodity at a price that offsets their costs, or at least meets their costs. And eventually, over time, if not very, very quickly, they'll leave the marketplace. And we'll see that the market will return back to Q star and P star, where at this quantity Q star, the maximum price that buyers are willing to pay is equal to the minimum price that sellers are willing to accept, and they can both find some sort of price that makes them both better off, or at least holds both of them harmless, as is the case for the marginal buyer and marginal seller. Now, we can go on and kind of look at the other case where the price that prevails in the market is less than P star, let's say P prime. Now, in this case, we see that the quantity demanded is out here, as measured by the point where the price intersects the demand curve, and quantity supplied is down here, as determined where the price intersects the supply curve. Now we have a shortage, or excess demand, meaning that there's more demand relative to supply. In the case of a shortage, buyers are going to find themselves oftentimes dissatisfied, because there are more buyers, i.e. the number of buyers or the number of quantity demanded along this demand curve exceeds the number of sellers as measured by the sellers along this portion of the supply curve. So a lot of buyers are going to find themselves shopping around for a commodity that they can't find, because given such low prices, there aren't that many sellers willing to actually sell this commodity. How will these buyers who desperately want this commodity but can't seem to find it anywhere, how will they compete with other buyers to guarantee that what is produced goes to them as opposed to somebody else? Well, they're going to engage in the same kind of price competition that sellers did when they were dissatisfied, except buyers compete with each other by bidding up the price, not by bidding down the price. And this bidding process will push prices up. And now, as prices rise and rise and rise and rise, more sellers are going to realize that they can sell at a higher price, and that's going to increase their quantity supplied. as measured, a movement up along the supply curve. And as these prices rise, a lot of a lot of buyers on the margin are going to realize that it's just not worth it to them to buy this commodity at this higher price, and they're going to leave the market as indicated by leftward, upward movement along the demand curve, a decrease in quantity demanded. And as prices rise, there'll be a smaller and smaller and smaller shortage until prices rise to the point where, you guessed it, they're at P star, where the quantity demanded is equal to quantity supplied and the shortage has been eliminated. Point. At P star, Q star, we would think that, assuming that there are no changes, and we'll address those potential changes later on, there's no reason to think that the market will deviate from P star and Q star. We're at equilibrium. Another way of looking at this is a scenario where maybe we're producing too little relative to Q star. So we're producing Q prime, which is to the left of Q star, at which point we see the maximum price the buyers are willing to pay, is measured by their demand curve's height, is P double prime, and the minimum price the sellers are willing to accept for this unit is P prime. So clearly there's a price in between P double prime and P prime that both buyer and seller can agree upon when deciding whether or not to trade in the Q prime unit. In fact, for any of the quantities where the height of the demand curve exceeds the height of the supply curve, buyers and sellers can agree upon a price that will make them both better off. And if they don't agree to those transactions, for whatever reason, then we can view the area of this blue triangle as unexploited gains from trade, because the benefits of producing these units, measured again by the height of the demand curve, exceeds the cost as measured by the height of the supply curve. So the net gains to society can be viewed as just the area of this blue triangle here. And if we don't trade in those commodities, well, then we've left gains on the table. We've not taken advantage of the full gains in trade that are out there. So the fact that buyer and seller can agree upon a price, given this condition, makes us think that eventually those units in between Q prime and Q star will be traded, and the market will move itself towards Q star, at which point the price is P star, and at that point buyer and seller. So we're returning to this equilibrium case, and again, I take it for granted that the market moves towards Q star and P star over the course of the long run. So let's imagine that we've got a market for cellular service, so cell phones. And on the y-axis, I'm measuring the monthly price for a contract, and on the x-axis, I'm measuring just the number of contracts that are bought and sold, at a given month's time. And it'll begin from a point of equilibrium. And let's assume now that for whatever reason, maybe there's a recession, incomes fall. And incomes are falling, and let's also assume that cellular service, cell phone service is a normal good. So declining incomes are going to ultimately lead to a reduction in demand, a leftward downward shift in the demand curve, something like this. Now, assuming that prices are a little bit sticky, what we want to do is look at what happens in the marketplace that was once in equilibrium and has now experienced a shock to its demand curve, but the prices haven't changed quite yet. So notice that given the new demand curve D prime, at the original prices P star, there's now a surplus in the marketplace. At P star, the quantity supplied hasn't changed. It's QS, which is where Q star used to be, but the quantity demanded has dropped. It's down here now. So we find ourselves in an environment where, due to lower incomes, there's now less demand relative to supply for this commodity, and there's a surplus. A lot of sellers have found themselves producing too much cellular service, meaning that maybe they have too many stores open across the United States, or they have too many employees trying to sell and market and service these contracts, but there aren't just that many contracts that really need servicing anymore. So for whatever reason, there's too much being produced relative to what's being demanded, and sellers will quickly realize this. At least some of them will, and those who can will try to compete for that very limited number of buyers by lowering their price. by offering a cheaper commodity, holding all else equal. And assuming that buyers always flock to the lowest cost seller, again, holding all else equal, quality and whatnot, it's not going to take long for prices to be pushed down and for a lot of high-cost sellers to leave the market. So a reduction in the quantity supply to move it down along the supply curve. And with the falling prices, an increase in the quantity demanded. And this process will continue and continue and continue until that surplus is eliminated, which will be at that new intersection point, the new equilibrium point, P star and Q star. And we see here, compared to the original equilibrium point, we have now lower prices and a lower quantity. Now, we can also look at what happens when the demand curve increases. So we could talk about the market for, let's say, soybeans. And now along the y-axis, we're measuring the price of soybeans, so price per bushel, and the quantity is now bushels of soybeans. Maybe bought and sold in the United States in a given calendar year, for instance. And we can talk about recent government initiatives to promote biofuel production and consumption. Tax increase the demand for biofuels. Increased demand for ethanol is going to lead to increased demand for soybeans because soybeans are a major ingredient to making ethanol. So let's assume, for instance, that the demand for soybeans has increased. Now, what's going to happen here? Well, in the short run, we're going to assume that prices don't change. So at the original equilibrium price of P star, the first thing that we should notice is that, well, now there's a shortage. Quantity demanded has now increased. The quantity supplied has not changed at all because farmers of soybeans, their cost structure hasn't changed. The incentives to them haven't changed yet, so they're going to be supplied the exact same amount. So now there are buyers who are dissatisfied. A lot of buyers are quickly going to realize that I can't get what I need at such low prices. The only way that I can kind of guarantee that I can get what I want is by outbidding the next guy. So buyers are going to slowly outbid one another for this very, very limited supply of soybeans. As prices begin to rise, some buyers who are on the margin will fall out of the market, and sellers, farmers in this case maybe, who are able to produce soy, corn, wheat, alfalfa, whatever, they might quickly substitute away from those other alternatives and start producing more soy because the price has increased, making it a bit more attractive. So as prices rise, we're going to see an increase in the quantity supplied, a decline in the quantity demanded. And this process will continue and continue and continue until prices rise to the point where we've reached a new equilibrium point, P star, Q star, where we have higher prices and higher quantity demanded. We could also talk about what might happen in the market for tofu. Tofu being a soy-based product. So if the price of soybeans rises, what happens to the market for tofu, which is its own market but relies heavily on soybeans as an input? Well, if government incentives to increase ethanol consumption lead to higher prices in the soybean market, that means that there are higher input costs for tofu manufacturers, which means that their supply curves will shift up and to the left. Now, again, holding prices fixed, this is going to lead to a shortage because at the given price per pound of tofu, quantity demanded might not change, but manufacturers of tofu might not be producing quite as much because it's a little bit less profitable because it's more expensive to produce now. Consumers realizing this will start to outbid one another and raise price, and prices will continue to rise until a new equilibrium point is reached. And in this case, that'll be with higher prices but less bought and sold at the new equilibrium. So a higher P star but a lower Q star. Then lastly, we can look at a scenario where there's an increase in supply. So for instance, I got an example here where we're focusing on the market for pickup trucks. And here, as an auto manufacturer, you can choose to produce more or less pickup trucks in exchange for fewer or more sedans. Now, let's say that the price of a related good, a substitute in production here, sedans, falls. So sedans are falling in price, which makes trucks a bit more desirable to produce from the perspective of a seller. So the supply curve for trucks is actually going to shift to the right or down to the right, where the price of the alternative production alternative sedans declines. So you see here that a rightward shift in the supply curve is temporarily going to lead to a surplus in the marketplace, holding prices of trucks constant. There's a lot being sold or supplied, but not so much being demanded. Sellers will quickly realize this, that they got a surplus on their hands, and they're going to compete with each other. So Toyota will compete with Ford and Chrysler and GM. They're all competing to unload this inventory, especially as the year comes to an end and they need to start making room for the newer models. And they're going to compete with each other by bidding down prices, by offering sales, discounts, whatever, lowering their prices. And as prices for trucks declines, we're going to see an increase in quantity demanded. More and more buyers will take advantage of that lower price. They might buy more trucks as opposed to sedans because they were kind of on the margin in between the two. And sellers will produce less in the future because prices have declined for trucks, which means that they aren't quite as desirable as they were prior to that small decline, that decline from P-Star. And the new equilibrium will now be lower equilibrium prices, but higher quantity bought and sold. So an increase in supply leads to more being bought and sold at the new equilibrium, but at a lower price.